All right, let's just get right to it. Looking at the screens, the tape is telling a very specific story this morning. S&P 500 futures, the ES. They are absolutely pinned to the flat line.
Pinned is the word.
We're hovering just ticks below that psychological 7,000 handle. It's so close, but we just can't seem to punch through. It's like a glass ceiling.
It really feels like the entire market is just holding its breath. You can see it in the order book. The liquidity is, well, it's thinning out. Everyone's waiting.
And if you look at the Nasdaq futures, the NQ, they're lagging.
Yeah.
I mean, lagging significantly. We all know the culprit there.
Oh, yeah. That Microsoft drag is heavy.
The status on the desk is a definite wait and see. We're in a holding pattern, but you can feel the engines revving.
It's the classic calm before the storm. Everyone is terrified of making a move before that 8:30 a.m. PPI print. That is the catalyst.
The producer price index. Let's set the table here, because sometimes this data point gets a little overlooked for, CPI. Yeah. Why so much weight on PPI this morning?
It's all about the context. Look, after Wednesday's Fed pause, where they use that solid expansion language, the market is desperate for confirmation that inflation is actually dead.
And PPI is the first look.
It's the first look. It measures inflation at the wholesale level, right? Before it even hits you, the consumer. If producers are paying more today, you better believe consumers are paying more tomorrow.
So it's the canary in the coal mine.
Exactly. It's a leading indicator. And with the 10-year yield holding steady where it is, a hot number on PPI, I mean a number showing prices are rising again, that breaks the peace immediately.
And while we wait for that, we have some serious pre-market movers. This isn't a uniform market today. We are seeing a massive divergence.
Huge divergence.
I want to start with Meta. Meta, it's up 9% pre-market. That is a massive move for a company that size.
That's the efficiency story playing out in real time.
It is. Zuckerberg basically stood up and proved that all that AI spend actually equals ad revenue growth. He showed the receipts. He connected the dots.
But then you flip the coin.
You flip the coin to Microsoft, down 10%, the Azure letdown. Yeah. Investors are absolutely punishing that high spend without the immediate margin pop.
It's a tale of two CapEx strategies, or really two different timelines for the ROI. Meta is spending to fixed ads right now. That's immediate gratification. Microsoft is spending, what, $37.5 billion to build future infrastructure? The market's impatient.
It feels like a shift from growth at any cost to maybe growth with visible ROI.
Precisely. The market is asking, where is the return on investment? If you're spending that much, show me the profit now, not in 2028.
And don't ignore the macro proxies here. Big oil. Exxon and Chevron are reporting now. We have to watch those, not just for energy, but for the macro health read.
That's right.
Okay, so let's zoom out to the hook for the day. We have a government funding deadline. Midnight tonight. The S&P 7,000 ceiling is directly overhead. The next 12 hours, they determine if January ends with a breakout or a classic bull trap.
It's a binary outcome day. You rarely get days that are this black and white.
So let's unpack that macro view. Why this specific setup? To me, it looks like a massive rotation. But is this capital leaving the market or just moving rooms?
It's definitely moving rooms. And that's important. This isn't a total cash-out panic. It's capital flight, sure, but it's internal. Money is fleeing high multiple tech and seeking refuge in energy and finance.
And the trigger was clearly Microsoft.
Microsoft's 10% plunge just shattered the AI CapEx is infinite narrative. I mean, for the last year, the assumption was big tech could spend unlimited money on NVIDIA chips and the market would cheer.
Right.
But when you see Azure growth slowing to 38% while they're spending that kind of cash, it forces a reevaluation of the whole software stack.
Investors are waking up. They're realizing that buying GPUs doesn't automatically print money.
And so what here is critical? If the jobs report, we're expecting plus 70K if that prints too hot.
Way more jobs than expected.
Yeah, it just confirms the hawkish narrative. It kills any chance of the Fed cutting rates in February.
And that ties directly into the political overlay we're seeing, which is arguably the biggest shadow over the market this morning. The rumors about Kevin Warsh.
Speculation is mounting that Kevin Warsh will be the next Fed chair nominee.
For those who don't follow Fed history, Warsh is a former governor. Why is the market reacting so violently to just his name? It's just a rumor.
Because markets hate uncertainty, but they hate a known hawk even more. Warsh is an inflation hawk. He's been critical of the Fed, arguing they were too slow to raise rates. If he gets the nod, the bond market is going to front-run a tighter policy.
He's the anti-Powell, in a way. Powell wants to land the plane softly. Warsh might just slam it on the runway to make sure the inflation engine is off.
In terms of market perception, yes. And that's causing this surge in yields. It's repricing that lower for longer dream that bulls were clinging to. Financial conditions are tightening right now, pre-market, purely on a rumor.
Okay, let's check the data on that. The 10-year yield is spiking, up 5 basis points to 4.27%. A 5 basis point move pre-market is significant.
It's a jolt.
And the dollar index, the DXY, up 0.2% to 96.48.
That right there is a double headwind. You cannot ignore this. Let's break down why this hurts tech. When yields rise, the discount rate rises.
Okay, break that down. Why does a higher yield hurt a company like Microsoft more than, say, a bank?
It's all about the timing of the cash. Most of the value of a company like Microsoft comes from profits we expect them to make, 5, 10 years from now. To figure out what that's worth today, you have to discount it back. The higher the interest rate, the less those future dollars are worth today.
It shrinks the present value of the future dream.
Perfectly said. And the stronger dollar. That hits international margins. Big tech sells all over the world. If the dollar is strong, the euro or yen they earn is worth less when they bring it back home.
So they get hit on valuation from yields and on earnings from the dollar. It's a pincer movement.
It is, and that's why the Nasdaq is under so much pressure.
So we have a rotation out of software, but where's the money going? There is an alpha sector today, and it's semiconductors. They're not the usual suspects.
No, and this is the fascinating shift. We're moving from pure GPU speculation, the chips that run ChatGPT, to full-scale adoption. It's the physical layer of the 2026 build-out.
Let's dive into the tickers. Number 1, Texas Instruments, TXN, up 7% pre-market. Now, TXN is usually seen as, a boring stock.
This is the signal I'm watching most closely. Texas Instruments doesn't make sexy AI chips. They make analog chips.
What's the distinction there? Why should you care about analog chips?
Analog chips are the interface between the digital world and the real world. They interpret temperature, speed, pressure, sound. They go into cars, washing machines, factory robots. You can't have an automated factory without them.
They're the nervous system of the industrial economy.
That's a perfect analogy. For the last year, the industrial economy has been in a recession while AI boomed. But TXN's earnings beat, and that golden 2026 outlook, it tells us they've found the analog bottom. Industrial and automotive orders are coming back.
That's huge. It suggests the real economy is waking up just as the AI hype might be cooling.
Exactly. It's a hand up. The baton is being passed from cloud to concrete.
So levels for TXN. If this clears pre-market highs, the target is the street high of 225, a fresh all-time high.
That's the breakout trade. If you see volume coming in above the open, that's where the institutional money is flowing.
But the bear case, what's the level to watch?
A failure to hold 210, that risks a gap fill down to 208. You have to watch that open. If it gaps up and immediately sells off, that's a bad sign. It means traders are using the liquidity to exit, not enter.
Agreed. Now contrast that with the black sheep of the day, Microsoft, MSFT, down anywhere from 7 to 10%.
The numbers are just staggering. $37.5 billion in AI capex versus that slowing Azure growth. That is the pain point. The market can handle massive spending, but only if growth accelerates. Microsoft failed that test.
For the traders, the bull case level, if there is one, it needs to reclaim 487 to invalidate this flush. That's a tall order.
Very tall. Honestly, I wouldn't have touched the long side today. The more likely battle is the bear case level. Technical support sits at 444.
Why 444?
It's a previous consolidation zone, where the stock spent time building a base. If MSFT breaks 444, the correction deepens into the 420s, and that drags the whole index down.
And quickly, ExxonMobil, XOM, the proxy for this rotation.
This is the hedge. If you're worried about tech valuations or war, you buy real assets. You buy the companies pulling resources out of the ground.
Bull case is a target of a 128. Bear case is a 115 floor.
It's simple. In a world of uncertainty, cash flow is king. Exxon prints cash.
Let's look at the lines in the sand for the indices. S&P 500, the ES, this 7,000 level. It's not just a number, is it?
No, it's a fortress. We're calling it the wall. Resistance is 7,000 to 7,025. We've seen multiple rejections. Every time we touch it, sellers step in. There is zero long conviction until we get a daily close above this.
So the floor support is 6,900, Thursday's low.
And here's the risk. A break below 6,900 targets the 6,830 gap fill. That's an air pocket. If that PPI number comes in hot, expect 6,900 to be tested immediately.
Move to the Nasdaq 100, the NQ. Tech is the stress test, and the Microsoft halo effect is now cloud cover.
It's heavy supply overhead. Everyone who bought Microsoft in the last 3 months is now underwater. They are looking to sell just to break even.
Resistance is at 25,858. Support is 24,625.
That 24,625 level is the make or break for the AI supercycle.
Yeah.
If we lose that, we aren't just in a dip, we start a corrective phase.
So the strategy on the NQ is to fade rips toward 25,200 until that 21-day EMA is reclaimed.
Correct. Don't buy the bounce until the trend proves itself. The trend is your enemy in tech right now.
Which brings us to the overall strategy. Liquidity trap or breakout. What's the read?
The status is a liquidity trap in tech and a stalled breakout in the broad market.
Let's define liquidity trap in this context so people know what to look for.
Okay, think about the buyers who stepped in early this week when the S&P hit 7,000. They bought the breakout. Now, Friday morning, they are trapped by this Microsoft gap down. They're holding losses.
They're underwater, and when people are trapped, they panic.
Exactly. They become forced sellers. And CFTC data shows heavy crowding in longs. Everyone's on the same side of the boat. The risk is that the trap is triggered when those buyers finally capitulate and sell.
The Friday flush.
Precisely. Unless we get a Goldilocks jobs print, the path of least resistance is down.
And the pain trade. We always warn the retail crowd about this.
This is crucial. Retail's looking at this dip and thinking, Fed pivot, buy the dip. It's muscle memory.
Right. But don't chase it today. The institutional pain trade, the one that hurts the most people, is a higher terminal rate regime. It's a prolonged sideways grind where yields stay above 4.2%.
The pain trade is the slow bleed. It's the market doing nothing for a year while your cash is earning 4%.
So the play is small position sizes. Watch the spread between TXN and MSFT.
That spread tells you the real story. If TXN holds up while MSFT falls, the rotation is healthy. If TXN starts falling too,
Then it's just a liquidation.
then get to cash. If the leaders of the new rotation fail, the whole thesis is invalid.
All right, final directive. Watch the 10-year yield. If it clears 4.300%, the AI bubble narrative dominates the weekend.
That's the signal. 4.3% is where equity valuations really start making sense.
Watch the 8.30 AM data. If ES loses 6,900, the January effect ends in a whipper. The bell rings in just a few minutes.
Stay nimble out there.
Let's trade.